Tom, good to see you. A really important topic today, 5 bond alternatives to consider right now. And the reason we're talking about it, let's just jump right in, is because of
Sure.
the good old 60/40 portfolio, which saw the second worst 6-month period in the last 50 years. Both stocks and bonds were declining. So the question here, Tom, can bonds still be considered that safe investment for people who are in retirement and need a stable income?
Well, it depends on what you consider safe.
Hmm.
It's a word that can go a couple different directions. Are they safe? Well, they're safer than stocks
Hmm.
when you look on the risk scale, but there is still risk. We have people that have been in bonds with low interest rates. Now we have a rising interest rate environment, which means that the value of your bonds are going down. Now, if you're holding them to maturity, you probably don't have much of an issue as far as getting your money back and things like that. But then there's the interest rate risk that you have because we have double-digit inflation. No matter what the government is telling you, it's actually double-digit. And so if you have one of these low interest rate bonds that you're depending on for income, you're actually losing money out of your pocket because you're not keeping up with the cost of living.
Yeah, I can tell you about inflation each time I go grocery shopping.
Same
So,
here.
the reason though we're talking about this stable income in retirement, it's so important. And now it's even more important because as we talk about the percentage of people who have a pension anymore, Tom, as you can see,
Right.
it's fewer and fewer and fewer.
Yeah, unless you work for the government or you are part of a union, the likelihood is that you don't have one of those old-fashioned pensions that maybe our parents and our grandparents had. Uh, that's why we're huge proponents of creating guaranteed income streams through your portfolio to help replace that. There's all kinds of studies done that people with guaranteed income streams live a healthier, happier retirement. And these studies have been done for 20, 30 years. I think the figure last time I saw was less than 11% of companies have a traditional defined benefit pension plan. So we're seeing fewer and fewer people with that
Mhm,
type of guaranteed income.
mhm. All right, so now let's walk through a few of the bond alternatives that
Sure.
you're recommending people consider. And one of them at the top of the list, fixed annuities, fixed index annuities, which are actually, they saw a huge bump last year, Tom.
Yeah, because they're fixed, they're guaranteed, and you know what you're going to get out of them for the
Hmm.
most part. Another thing that fixed annuities and indexed annuities have is something called the mortality credit, which no other investment has. My friend Tom Hegna tells a little story about 4 little old ladies who go to the beach and they decide they're going to save a little bit of money for next year. So they each put in a pot, $100 into a pot. Well, during that one year, one of the ladies pass away, and then the 3 of them come back to the beach. They open up the can, and there's $400 in there. So each of them made 33% on their money. So that's what a mortality credit is. They didn't earn an interest rate, right? But because of their longevity, annuities will pay out a little bit more.
Hmm. Hmm.
So that's one of the benefits. Again, fixed annuities, you can get them, their interest rate guarantees. The indexed annuities have floors to protect you from market losses, potential on the upside. So
Hmm.
great alternatives.
Hmm. It's a great story, macabre, but it does help illustrate that point. I get it.
It
All
does.
right. Next on your list, buffered or defined outcome ETFs.
So these are similar to the indexed annuities. So you're going to be investing in an ETF, mutual fund, or something along those lines, and they're going to have a floor and they're going to have a cap of some sort or a ceiling of what you can earn on them. Because in order to get downside protection, you're going to be giving something up on the upside. The annuities and these type of ETFs, buffered strategies, are things that people like Moshe Milevsky and Dr. Wade Pfau and Roger Ibbotson all are big proponents and fans of. There are different ways to generate income in a somewhat safe environment without taking undue risk on your portfolio. So it's not just Tom O'Connell or Tom Hegna saying these things. It's finance professors, doctors of economics. So there's a lot of information out there for folks.
Hmm. And structured notes, they're kind of a similar product. Is that right?
Yeah, so structured note is built sort of like a CD, where You have, again, you can have a downside buffer with an upside interest rate. They're typically 1, 2, 3, 4, 5 years maturity levels. So they're an excellent tool to utilize. But again, you just have to understand the risks that you're taking with it. But I use them a lot in client portfolio these days to get much better than interest rate, CD interest rate types of returns for clients.
Okay. Something else that I feel like I'm hearing a lot about lately, REITs, real estate investment trusts.
Yes. So REITs are, again, they're designed to create income or dividends for people, but you have to, once again, you have to understand what you're getting into. Back in the 2008 era, a lot of REITs either cut their dividends, got rid of their dividends, or they went under. So you have to understand what your REIT is invested in. You have to understand how much leverage they're taking within their portfolio. But again, it's a good alternative to get a higher than CD rate of return, money market rate of return.
Okay. And last, and maybe most important, or at least one of your favorites, Tom, cash value life insurance.
Cash value life insurance. So again, traditional whole life policies are paying 300-400% more than what you would earn in a CD or savings account or money market account, backstopped by the insurance company themselves. So you definitely want to look at the credit rating of the insurance company. But they also are sort of like a supercharged Roth IRA, right? They're growing tax deferred. They're getting compounding interest using the loan mechanism. You can get money out of them tax free. So there's a lot of advantages. The Nelson Nash theory of becoming your own banker. You have your own capital pool. So there's a lot of levers to pull with the cash value life insurance.
Yeah. Well, this is helpful, at least realizing that there are alternatives out there, because like we said, with pensions, at least somebody else was taking care of it. But it's nice to kind of walk through these options, Tom. If somebody has questions about any of these alternatives, what's the best way to reach you?
Either by phone or email. So phone number 973-394-0623. You can go to our website, www.internationalfinancial.com. My email address is just tjoconnell@internationalfinancial.com. And we're happy to help.
Yes. Tom, thank you.
Thanks, Erin.